Want to explain to you how this is going to work going over the next subsequent days and through all the curriculum. There's a lot of hours of curriculum and many days that we're going to be speaking with you. And the way that we set this up is in a very logical or chronological fashion, and that is that we start from what I would call a satellite view. Really, really wide, looking at perspective. We start off with keep putting things into perspective, and then we go to an aerial view. We start zooming up, and from there we go to an overhead view, and finally we're at a microscopic view. And how you can sort of picture this is that we're starting off from left to right. Think about it as a chart, a stock chart, and starting off from the left where you may be just starting an uptrend, and then from there we'll talk about the trend. We'll talk about that first part of the market cycle, and then the current chart pattern. We're going to go through chart patterns and price and volume. We're going to add the fundamentals to that, what you need to look for with fundamentals, and also we're going to go into position management and risk management as well. So it sort of works its way from left to right, and then from an aerial view or a satellite view all the way down to where we get very microscopic, down to the exact buy point and exactly what you need to look for at that precise moment to buy and sell and to manage the position and the risk. So with that, we're going to get started. We've got a lot to cover, so we dive right in. We're going to start off with just explaining specific entry point analysis, and what that exactly, what our goal is, or really what our goal is as a professional trader, and that is we're looking to always take a minimal risk relative to what we can expect on the upside. So we're looking to take a minimal risk and capture relatively large gains, and then the key is to turn that edge over to do that as many times as we need to do. If you were a shorter term trader, you'd have a smaller edge. You might be using maybe a tighter risk profile or tighter risk parameters and not getting as big gains, but you're turning that edge over more often. And of course, if you're a longer term investor, you wouldn't turn it over as much, but you'd have probably a much bigger gain. So we're going to go through the selection process. We're going to go through trade execution, and then of course, position management. There's 5 key areas that we're going to cover. All right. So, and these are the broad areas, and we're going to get into a lot of detail within each of these 5 areas, but these are the broad areas: categories and catalysts, price and volume. We're going to look at the company fundamentals, and then entry points and exit points. And that's, like I said, that's going to be based on your criteria to enter and also to manage risk and manage the position. So starting off with this perspective that we're going to look at, well, we like to categorize companies into 6 different categories: the market leader, the top competitor, institutional favorites, what we would call turnaround situations, cyclicals, and then the laggards, which would be the eroding fundamentals that we might actually go short. What we generally concentrate on are the first 4: the market leader, the top competitor, the institutional favorite, and the turnaround situations. And I want to go over those right now. And Dave and I are going to explain, because there's going to be different, you're going to approach each of these slightly differently. There's a lot of things that are going to be similar. The chart analysis and some things are going to be similar, but there's some things with the fundamentals and other aspects that we're going to have to look at a market leader a little bit differently than we might look at a turnaround situation when we're maybe looking at earnings or institutional favorite. There's a stock that is already a stock that's well known and maybe is not a new market leader. So let's talk about that right now. We're going to start off with the market leader. So, and Dave, we've been trading these market leaders for a long time. Can you just real briefly just talk about why was our first choice a market leader? Why do we want to go with this as our very first choice as the market leader?
Well, the market leaders are usually the ones that make the greatest gains, and these are the ones that you want to be on. And the interesting thing that another point I would put under market leader is most people don't know the name of this. You mentioned institutional favorites. Everybody knows institutional names, but the market leader in a whole new bull market is usually a name that no one knows about. And it has big earnings and it's just starting to break out. But you go to a party and you start talking about this name that just emerged, and most people are going to go, what in the world is that? That is usually the stock that makes the biggest move in the coming bull market.
Yeah, Dave, and I found also, in this, maybe this most recent, secular bull market, we've had these, FANG type stocks and big mega caps have actually been categorized as market leaders. But again, when you get a stock like, an Amazon or, Netflix maybe, or Google, maybe PayPal, some of these names that have made these big, enormous moves, 80, 100,000% over, a decade or two, and you see there's, you look at the institutional sponsorship, there's, 6,000 mutual funds that own it. These are names of the past. They're the chances that they're going to be the next big market mover that makes another move like that is very slim. We've seen this, Dave. How many cycles? I mean, you go back and I like to point out some of the names and that were in coming off the 1990 bear market that today everybody looks at as a household name. But when I was buying Amazon in '97 or buying Dell Computer and Amgen in 1991, I mean nobody knew those names, right?
Right. But the other thing to do is you don't. You want to have as many market leaders as you can, but sometimes it's actually good to mix in some of the top competitors and institutional favorites and even turnaround situations to give your portfolio a little balance, because sometimes if every single one of your stocks is market leaders, you could have some great moves, but you're going to probably have a lot more volatility with these, but you still want as many market leaders as you can.
Right. So that's a good way to segue into this now. So let's talk about, and that's why we're going to talk about these four areas, and that's where we concentrate are in these four areas, because you're going to have definitely opportunities in all four. So the first choice would be the market leader. So let's discuss and talk about what is this market leader and what it looks like. So these are stocks that are usually first to emerge in a new bull market. And very often, we're going to show you in just a second how they'll be moving into new high ground when the market is just coming off the lows. And sometimes while it's making new lows, sometimes you'll have a stock will actually bottom. It starts moving into new high ground coming out of a base, and the market hasn't even bottomed yet. It still has another leg down. And we'll show you many examples in just a little while. They're also usually very expensive, or at least they appear expensive. They're actually cheap, but they have usually a high PE. They're trading near their 52-week high, so they appear expensive, but actually, some of the stocks that are really expensive are the ones that near 52-week lows, and they look cheap, but they're actually very expensive because their earnings are of poor quality. With the leader, you're going to usually have very strong earnings, sales margins, relative strength is going to be among the absolute best, the top, 1, 2, 4, 5% of the market. And like David just pointed out, this is where you're going to find a lot of small and mid-cap names. And I think this is where, we're getting conditioned over the last, I don't know how many years now, to stay away from this area of the small mid caps. I know, Dave, you and we've been waiting for the Russell to get going it just seems like forever now, and it's still it really hasn't been able to keep up with the larger names, but that certainly isn't going to stay that way forever. And there's certainly opportunities in the small and mid cap area, not just if the indexes are doing well.
Yeah, the other thing about this, a market leader, when it's first to emerge in a bull market, I actually really like this period, because sometimes it's very obvious which is going to be the next leader, because it is the first one to break into new highs. It's the first one to have its relative strength line go into new highs. So sometimes it's sticking out like a sore thumb in a very, very tough market, and everybody's going, what do they do? Who is this? What is this? But then, as time goes on, the thing just takes off and really starts becoming one of the big leaders in the marketplace. But when you're in a tough market, the ones that are bucking the trend and moving higher in a down market are the ones that probably going to be leading when the weight of the market comes off.
Yeah, and I think that's why so many people, miss these at the most opportune time. And certainly that was my issue when I first started in the stock market. I started as basically as a quant, which means I would form an opinion about the market. I was using all kinds of indicators and tea leaves and so forth, and I would wait until I was bullish on the market, and then I would look for the best groups that were acting the best, and then I would look for the stocks within those groups and pick the best stocks. The problem with that approach was by the time the market was doing well, the groups were doing well, the market leaders were already doubled and tripled and they were long gone. So I was constantly missing them and I was buying laggard stocks, which I don't even ever focus on anymore. I'm only focusing on market leaders in these areas that we're talking about. But back then I was just constantly being forced into these laggard areas because I just had the process backwards. So I flipped it completely around. I said, I'm going to look for the best stocks and let them lead me to the group. And if there's a lot of stocks that are meeting this criteria, then I'll conclude that the market is healthy, even if it doesn't appear so on the surface. And that's when all my performance changed. Let's talk about the top competitor now. Now, keep in mind, we're just giving you perspective here. We're just sort of setting the table, if you will. Putting down the placemats and the dishes, and we'll add in the forks and knives, and we'll actually start using them and showing you how to use these tools. But right now, we're literally just setting the table and just giving you just broad perspective. As a matter of fact, the next several sessions are going to be all perspective based. So just bear with us and just and pay attention here, because this is important stuff, because later on this is going to come back on how you apply to certain areas in the market, these categories. So the top competitor. Now, this is where you're looking at your number 2, your number 3 company. And I always like to use this example. If I were to ask you, cola, soda, what would be your first choice? What would come to mind first? Probably Coke, right? Maybe Pepsi. So Coke and Pepsi. If I said, okay, what's number 3 that comes to your mind? I don't know, maybe RC Cola, or you'd come up with something else. But as we go down, let's say, okay, who's number 4? Who's number 5? All of a sudden, you can't so readily come up with that. And you could do this with just about anything. If I said home improvement, you'd probably, right? Home Depot, Lowe's would come to mind, right? What's number 3? What's number 4? As you start getting to 3, 4, 5, 6, it just gets harder and harder to identify the leaders in that area, right? Same thing with, let's say, coffee. Coffee, you'd think of Starbucks and Dunkin' Donuts, right? Maybe if you're Canadian, Tim Hortons, right? But as you get to number 5, you start drawing a blank. So that's because, and in marketing they call it the law of duality, where it basically the market comes down to just a couple leaders in any one market space that dominate a space, and that's really how it works. In the stock market, the real true leaders are usually going to be, there's only going to be a handful of them in any one group. And then you get the laggard stocks. Now, on occasion, and we're going to show you this later on occasion, you can have the top competitor can actually leapfrog the market leader. This happened with Home Depot and Lowe's. If you go back and remember, Home Depot was the clear market leader. They really sort of defined that space with that home improvement. And then later on, they started to slip a bit. Their stores got a little bit dingy. They started to have a lot of builders, and it was getting to be more of a wholesale type environment. And then Lowe's took advantage of that, and they had the brighter stores and went more retail, and they actually did much better than Home Depot for a little while. So you can see this happen. But usually what will happen is, when you're coming off of a bear market, you're going into that new bull market, you'll get these names will move together. So you don't want to just look for just the only one name. There might be 2, 3, or 4 names in a group that are investable or tradable at least. And again, they're gonna lead in fundamentals. They're gonna lead in performance when you get with the market leaders. And these top competitors might lag a bit, but they're still going to be very good stocks to invest in during that period.
And I would also add that the third point in terms of top competitors move together in a strong group that you mentioned. Anytime I sort a list of stocks, I usually sort it by group strength. And so I'm always looking at the top on MarketSmith there's 198 groups. I look at the top 50 very closely and I see what are the strongest groups in those 50. And I look at the strongest stocks within those groups. And so, as it says, lots of times when you get a strong group moved, you're going to have some really great performance in the top few stocks within that group. So group strength is very, very important.
Now, sometimes you'll have a group like the semiconductor group, which is a very large group, and there's a lot of companies in the semiconductor group, and there's some groups like that have a big list of names in it, and you might get, there may be a good handful of names, or there's a lot more than just a few names, but generally speaking, your true leaders are going to be 1 or 2 or 3 names, and like I said, those are going to be your top competitors. Now, the institutional favorite, this is your name that. Right now, an institutional favorite, Dave, I guess Apple, Google, PayPal, what else are the names that they love that the institutions can't get enough of right now?
Home Depot, Costco, Starbucks, those are always institutional favorites.
These are going to be your big names, and these are what you would think of as a quality stock. These are the type of names that people say, oh, Coca-Cola is not going to go out of business, right? I'm safe with that. And we'll talk about that later as far as, safe. But you want to be careful, when a stock is the official growth stock and it's the quality leader, if you will, these are actually usually going from leader to laggard, because now, all the money's been moved into them and there's just nothing but supply. You've got thousands of mutual funds in there, where the market leader, sometimes you only have 50, 100 institutions in there. If you use a MarketSmith, and you can go in there and see the number of institutions that are in the stock and number of funds in there, there might be a very small number compared to, you look at Microsoft and there's thousands and thousands of funds in there. But there is an opportunity in this area too. All right. These are liquid names. These are the larger cap, sometimes mid, but usually large and mega cap. And these are very widely followed. Everybody knows them. All the analysts, follow them. Bear markets can provide really good opportunities in these. This is where you get a bear market, you might be looking to pick up an Amazon or some of these bigger names if they're meeting the proper criteria, and you can get a good move coming off of a bear market relative to the general market. But they tend to move with the market. They're more market type stocks, so they're going to go up when the S&P goes up, down when the S&P goes down. And this isn't this isn't your top area that you'll be looking for. You're really looking for the market leaders and the top competitors. But you're, like David said, you're going to throw in some of these institutional favorites, particularly coming off of a bear market. The turnaround situation. Now, this is where, again, you have to apply a few parameters a little bit differently on the turnaround situation. This is where you might get a company that fell on hard times, and we got a lot of turnaround situations in recent times after we've had the bear market from COVID and so forth. If you get a recession, you can have industries that fall on hard times, and now they're trying to recover their fundamentals. They're refocusing their business strategy, or maybe ridding losing operations. A new CEO, they might have a new CEO come in and turn things around. But the thing with these companies, you're going usually against what we call easy comps. So where a growth stock, you might look for, 20, 30% earnings might appear like that. That's pretty strong earnings. But with something that has been on very hard times and showing a bunch of losses, now in the most recent quarters, you're going to want to see huge earnings. 20, 30% for a turnaround situation would not be very strong. You'd want to see triple digits in the earnings and sales in the most recent few quarters, margin improvements. So again, how we're going to approach these various areas are going to be a little bit different not usually from the technicals as far as the charting is concerned, but on the fundamental side. Dave, anything to finish off here before we look at a few of these examples in each area?
Yeah, usually with turnarounds, you're going to have bad growth rates, but you're going to see that you really want to see one, if not two, very, very big, strong earnings, as you said, 100%, 150% improvement in those last two quarters. That's going to tell you, and along with a chart pattern and a relative strength that's improving, it's looking for those first two quarters of very strong earnings turn.
Right. Let's take a look now. We're going to go through each of these categories. We're going to look at a few examples and discuss them just to give more perspective and to zoom out a bit here. Let's look at this first stock. Dave, you probably remember this one well, Amgen, of course. This was really clear cut as far as a market leader is concerned, and this is one of the few biotech companies that at the time had strong earnings. Coming out of this base, if you will. And you can see, if you take a look here, let me get my little drawing tool or my little spotlight. There you go. You can see I'm actually buying this. Now, I want to point out another thing here. If you look at these prices, you're going to see prices that are, $1 or 50 cents. These are adjusted for stock splits. So we just taken the price now. These stocks have made big moves. So they're adjusted for stock splits. I don't buy stocks that are penny stocks or $1, $2 stocks. These were trading much higher at the time. So ignore the price. These are adjusted for stock splits. But at the time, this stock, we're in a bear market. And I remember I had actually gone to New York, and I was in New York City at a conference. It was the Ned Davis conference. There was a bunch of the newsletter writers there. That was where I actually met Stan Weinstein for the first time. And at the time, Marty Zweig, some of you maybe remember Marty Zweig. He wrote a book, Winning on Wall Street. So they were all bearish. Everybody was bearish. They were saying, we're going to go into a 1970 style bear market. This is going to be drawn out. It's just like it was like the end of the world. Everybody was calling. And I realized that it was just, I couldn't find one single person bullish, but I saw that, well, first of all, we came off the lows and we had a follow through day coming off the lows. So we had an official O'Neill follow-through day. But what was really getting my attention were there was a bunch of stocks in the medical area, the biotech area, some in the computer and computer peripherals software that were making new highs or very close to new highs coming out of bases. And I started buying a few of these names, and one of them was Amgen coming out here. And you can see the market's just coming off the lows. And at the time, Amgen is up 175%, while the market during that same period is down 35%. So showing this tremendous relative strength. That's what a market leader looks like. And that's why it's so hard to buy them at the most opportune time, because like I said, they're moving into new high ground, coming off the market's lows when you're in a bear market. And sometimes they even break out. If you can see, you came off here and this stock's going into new high ground before the bear market even really, starts really selling off here. So you could actually bought it, over here and coming out of this base. And you went into a bear market at the time, and the stock just kept moving itself higher. But this is where, and David was just saying that they really stick out. In corrections and in bear markets, this is why you're going to be looking for the names that are holding up the best. Look for those market leaders because they stand out like a sore thumb at that time.
Yeah, the other thing too about the markets is at this point you're seeing the market has been going down for 4 months, or you could even take it from the October high a year ago, and so. By the time you've been going through a very tough market and you can't be making any money, you're just not in the mood for your mindset is, this is so bad. I've lost money. When will this thing ever turn around? The news looks so bad, but that's where you just have to look at the information on the chart and what the chart is telling you. That it's telling you that this stock is already starting its move, and it's a new market leader. So sometimes you really have to concentrate on what the individual stocks are saying, and not so much the averages, the major market averages.
Now you may be thinking, wow, stocks up 175%, new highs. that stock looks expensive and high. And most of these are trading, like I said before. Remember, I said they're trading at high PEs. They look expensive. Okay, that may look high, right? But then let's take a look here. See, it doesn't look so high anymore, does it? Right. This is where I'm buying right here. So this is what a market leader, the potential of a market leader. And even if you're trading this and you're not going for the bigger move, you get a lot of opportunities to trade this in a very strong uptrend. And sometimes, you can trade. I traded stocks like Yahoo and some of these names that made 7,000-8,000% moves, and I was in and out of them 5, 10, 15 times for 100% move, a 60% move, a 30% move, and you compound all that out, and I got a pretty good lick on some of these, even trading in and out of them. So Amgen went up 360% in 26 months, and again, we're looking for, one of the criteria that we want is that we want a stock to be up prior to us buying it. We're going to talk about this later when we talk about the trend and the stage 2 uptrend, but we want the stock to be up at least 30, 40, 50% minimum. But most of the stocks that I traded, and Dave too, they're up 100%, 200, sometimes 300%. Now, here's another thing too I want to point out. Everything that we do, we're basing it off of facts, based on reverse factor modeling the market and what actually has shown to be the statistics and the information that leads to these market leaders. We're not like just pulling these numbers out of a hat or anything that we're doing. It's not we have a lot of anecdotal evidence, obviously. David's been trading over 40 years and I'm closing in on 40 years myself. So we've got about 80 years combined trading experience, but still, we're not trading off our opinions. We're trading off of facts. And I'm going to give you a fact right now. The average gain that a big market mover, a big market leader, this is based on the biggest moving stocks going back 100 years, all the way back to the late 1800s. The average gain that the stock made prior to it making its big move was about 350%. So again, this being up 175% is actually way below the average of what many of the market leaders were up prior to making their big moves. So let's take a look. Here's Lumber Liquidators. So this is another stock that was showing, tremendous strength while the market was correcting here. It wasn't a big bear market in 2012, but we did have a correction here. And here's the important distinction here. One of the things I love about getting into these market leaders and getting into these stocks that have a very strong relative strength, high alpha, they're in their own world. They're in their own world. They're in their own earnings cycle. And a lot of people talk about leverage. They ask me, do you use margin? Do you use leverage? Okay, I don't use margin or leverage too much anymore. But I did at one time when my account was small and I wanted to lever up. But the leverage that I get, and what I really like to do, is to get the leverage on the market by being in the powerful stocks. So here's a perfect example. You've got Lumber Liquidators, which is holding up, coming out of these, what you would call an ascending base, if you will, comes out here as a market leader. And the market doesn't even get into new high ground yet, and just starting to turn to new high ground. And this stock's already a double. All right. Now look at here. If we take a look over this period, the market's up, looking at the NASDAQ, is up 33%. Over that same period, this stock is up 240%. See, that's your leverage. That's the kind of leverage that you want. Not leveraging where you're putting on margin, but where you're actually getting the leverage because you're in the stocks that make such big moves. And even on a short-term basis, you can get stocks that are up 20, 25, 30% in just a matter of days or weeks. And the market, during that period probably won't move more than, single digits at most. So this is what these look like. Let's show you something that's a little more recent. DocuSign. So DocuSign is a perfect example of a stock was making new highs as the market's just coming off the lows. And if you remember here, Dave, I don't know about you, but myself, around this time when these stocks started making new highs, and then just a little bit after, you see this gap right here. I know it's kind of small, but this gap, that was a follow through day. And I started buying stocks right there. That's when I started adding stocks. I was scared to death at this time. I got to tell, Yeah, and I'm not ashamed to admit it. It was like the end of the world, COVID, and everybody was calling for a 1929, depression, or even worse. And of course, the coronavirus was a complete unknown. And you've got stocks that are making new highs. They're breaking out to new highs. Again, if you were to, use your gut or the news as your indicator, you'd never be in this name. And here's the same type of leverage. Similar to the lumber liquidators, the market's up about 36%. And in that same period of time, which is only a couple months, the stock's up 120%. So big move. That's where you get your leverage.
Yeah, that was a time where there were 10. I've never been through something that volatile that quickly. In terms of, there were 10% moves on a number of different days where the market was moving, and so much volatility. But again, to not look at the averages and look what some of the individual stocks are doing at their time. They're giving you a different message. They're saying, "Hey, I'm at the forefront of something that you should really take a look at," and you can see what kind of moves you can have with those types of stocks.
Yeah, unlike a lot of people, and you probably, on Twitter and so forth, and if you're one of our members, you know this all well. I really just follow the stocks. I mean, 95% of everything that I do, my decisions are based on the individual stocks and how they're acting, how the stocks in my own portfolio are acting. And that's why, I never get really caught off guard, either on the upside or the downside, because I'm not looking at the indexes as my lead indicator, because I'm trading stocks. So if the stocks are setting up, and this is something, we go back, we can talk about this with Mark Ritchie later when Mark Ritchie is here. But when this was all happening, Mark Ritchie and I were having a discussion, and I said, he's like, "What do we do here? The stocks are setting up, but it looks like the end of the world." I said, "We buy them. We buy them. They're setting up, they're breaking out. We buy stocks. If they stop us out, they stop us out. And then we buy them the next time they set up. But we got to buy something here because the stocks are setting up. And, we got a follow through day. So to confirm that the market, even the indexes look like they might have made a low. All right, this is all just perspective. All right. So we're going to talk a lot about this, but we're anywhere near getting into any specifics. So let's just keep moving here. And I want to talk about the top competitor next. Now, the top competitor, this is just a great example of how you can get leapfrogged by a stock that is a top competitor, and why you should watch the various names in a group that might be the leader, and then another name that's hot on their trails, like Lowe's to Home Depot is or was. Netflix and Blockbuster, and I know, Dave, you've had some interesting things to point out about Blockbuster, going back to we still have to wind the tapes and everything, but this was really, you look back now and you think about how archaic the Blockbuster model was. But at the time when Netflix came on the scene, if you will, Blockbuster, no one really thought that online, it wasn't even online. It started off with mailing you the CDs, and you would get or the DVDs. They would mail them to you. Is that right, Dave? They'd mail them to you, right? I'm trying to remember. Yeah. They would mail them to you, and then you had certain days to send them back to them, and so forth. And prior to that,
you could hold them as long as you wanted to. That was the great thing about it. There were no late fees on the Netflix movies.
That's right. No, the Blockbuster, you had to bring the video back.
Oh yeah, you had to get that thing back. If you didn't get it back by 10 o'clock by closing time, boom. I think I remember they had made something like $40 million on late fees in 1 year.
Oh wow, yeah, you get charged. That's right. And if you, God forbid, you forgot one and it fell behind your couch, and then I had that happen. I had it where I owed $82 on a movie that I rented, a couple of months earlier. I remember. I don't even know where it is.
Yeah, I was probably one of the first users of Netflix, because I just did not like how you had to get that thing back at the 10 o'clock on a Saturday night. It's just
now we're going back quite a ways here. I mean, we're going back to early 2000, right? Now here's something really interesting. Take a look right here. Netflix goes IPO. almost to the day that Blockbuster tops. Now, it took a long time. If you go here now, it's 2002, right? You go all the way to 2010, and that's where Blockbuster went basically BK. They went out of business and went bankrupt. Look at Netflix. Netflix comes on the scene. It's almost like the stock knows the there is an intelligence in there that's really amazing with the stocks. So the stock knows that this competition comes on, but look how it just basically marks time for 10 years. I bought Netflix for the first time in 2010, right here, just before this big move. So they wait until, or the stock waits until Blockbuster is vaporized. Once Blockbuster is completely out of the way, the Netflix, boom, takes off and goes up 500-600%. And since then, thousands and thousands of percent. And still to this day, this stock has still been holding up and is considered by many still a market leader, a secular market leader. So just the intelligence and the timing of this is, this is not a coincidence. This is definitely not a coincidence. To the day the stock tops, and almost to the day as it goes out of business, Netflix takes off here.
So another ironic thing is right now on Netflix, or at least in the last year or so, one of the most popular movies to watch is a documentary on the last Blockbuster, which I think is up in Oregon or Washington, and it's one of the most watched movies on Netflix.
I saw that, and is that there's still a Blockbuster, right?
I guess there's one still existing and still renting out DVDs.
Wow. So now let me show you something else that's pretty interesting. And again, I usually defer to my wife when it comes to fashion and purses and things like that. And in this particular area, I remember, my wife telling me that this is around the time when Michael Kors went public, and it started setting up this primary base here. And I was looking at Michael Kors, and she told me, she said, yeah, Michael Kors is, coming out with a sort of a line that's kind of like Coach, but they're more trendy and catching on. And sure enough, look at how, again, almost to the day where it goes IPO, Kors goes IPO, right? And just shortly after, Coach tops. And then over this next, 2 years, if you will, Kors goes up 329%. Michael Kors, 329%, while Coach goes down 50%, 56%, and cuts its stock price in half. Now, this is two companies in the exact same industry that have like basically the same price point, as close competitors as you can get. But Kors came in, and these trends are very fickle. This happened with Reebok and Nike. You can go back and see it in the sneaker area. So again, there's an intelligence, in the market. And when these stocks set up, and I should say also, not only when they set up, but, if you're a fan of Coach, and this top competitor now comes on the scene, and you start getting sell signals on Coach, you want to get out. Not only do you want to get into Michael Kors, but you want to get the heck out of Coach and get out of that previous leader that is no longer a leader. So again, this is, once again, why you want to watch those top 2-3 names in a particular group. One other thing I want to talk about, we would be remiss not to bring up Amazon, because Amazon has got to be the ultimate top competitor probably in the history of the stock market. That it was a disruptor, and this is all disruption. This is all about disruption, disrupting an industry, a technology. Amazon first. If you those who have been watching for a number of decades with Amazon and how this all started, it started with books, and it started with basically vaporizing Barnes and Noble, and then the entire book industry. Apple did the same thing with their desktop publishing, where they just wiped out the printing industry and the big web presses and all that, and brought desktop publishing. It was a very similar type of assault on a particular area of the economy, if you will. And Amazon did it first with books, and then of course eventually with everything. I mean, you take a look at versus Barnes and Noble versus Sears, and now of course they're into everything. They practically rule the world. So again, this is all about disruption. Following those top companies in an area, and again, we're just giving you perspective here. Let's look at the institutional favorite now. Now, I actually traded and bought Cisco early on here. It went IPO in 1990 and came off of that first IPO base. And I actually traded it for, I forget it was a very small trade, very small move. And then the stock had this giant move. I think it was 70 or 80,000% and went up over, about the next decade. But once you got where this stock made this giant move, I mean, it was just considered as like completely bulletproof. I think they had 16 straight quarters of triple digit earnings. It was just considered, a must own, even when it first cracked and it was down 50, 60, 70%. Everybody I knew at the gym, they were buying it down. Oh my God, I bought Cisco down 70%. What a bargain. This stock has still not recovered. It's been, 20 years, and that stock is still, I don't think to this day, it's not even back to break even, right, Dave?
Yeah, it hasn't gotten to back to that high of 2000. It's getting closer, but 21 years later.
So now you turn into this stalwart, if you will, or turn into this laggard where, these can stay indefinitely, where they don't make big moves, or they just, they top and they don't go anywhere for, decades. So and this is the same story every single cycle going back 100 years. You go back to the 1970s. Xerox was like, high tech. That was like the high tech company of the day. Of course, later was IBM, going into the 80s and so forth. But Xerox and Kodak and Eastman Kodak, those two were super high tech in the 1970s. They topped from the 70s, in the 70s market top. Those stocks topped, and then it was 24 years before they even got back to break even. And during that time, the S&P 500 went up 500%, and all kinds of market leaders made huge, enormous, multi-1,000% gains during that period. And meanwhile, you got to buy Eastman Kodak, you got to buy Xerox when it's down. Avon Products is probably the ultimate example of that.
Yeah, and I think this is an important point, that there's a huge difference between a great company and a great stock. You could have a great company and it's had a great reputation, and it's grown over so many years. But if that growth starts slowing down, it could be a horrible stock. Even though it's still a great company, probably a great company to work for, you really have to separate. You want a great company and you want a great stock at the exact same time. Who wants to sit with a stock for 21 years? Yes, you got a great name, but your money is not being treated the way it should.
Yeah, and that's absolutely true. And taking a look here, Qualcomm, back in the 1990s, Qualcomm was all the rage. I mean, that was hotter than any stock that I've seen, even in recent times, where we've had some pretty hot names with these meme stocks and all kinds of just these quick, fast movers and SPAC area and all that. Qualcomm, though, was just a cult following around Qualcomm and another number of names, which were basically kind of like the FANG names back then. These were the FANG stocks, and by the time they made these big, huge, multi-1,000% moves, all the institutions owned them, and again, 21 years to get back to break even. So, I mean, yeah, you can look and say, well, if I bought it when it was down here, I did great. Yeah, if you happen to, buy it right at the low, but, which 50% decline would have been the one that you would have picked? The first one, the second one, the third one, the fourth one, just kept cutting in half and cutting in half. The chances that you would time it that well is practically zero. It's real quick, Dave, because I had a point that I wanted to make, and I can't remember. What did you just say previously?
I said that there's a huge difference between a company, a great company that has a great reputation, and a great stock. It would be great to have both, but if the stock is not performing well, no matter what its reputation is, you shouldn't be in that stock. And you might have said this, or someone said that the only good stocks are stocks that go up. You don't want stocks that go down and just go sideways for years.
That's precisely where I was going with this, and I forgot that point I was going to make. So thank you. The point that I was going to make was that my number one rule, and I learned this from O'Neill, was all stocks are bad unless they're going up. That is literally my absolute number one rule, is that I don't look at any stock as a good stock or even a good company unless the price is going up, unless it's performing. If it's not performing, then it's not a good stock. And it doesn't matter if it's a good company. Good companies could make terrible investments for decades and decades, and some of them go out of business. Whether it's Coca-Cola. I mean, I know a lot of people look at, well, what about Warren Buffett and this and that? Well, again, that's, first of all, Warren Buffett is not getting super performance, not getting triple-digit returns. He's beat the S&P by, I don't know, 3 or 4%. And there's also, you could look at Berkshire Hathaway, there's been, declines of, 50, 60%, or I don't know if that number is exact, but certainly, 50% declines. Coca-Cola, was his prize investment, and that got into a lot of trouble and took a long time. To this day, it's been a laggard for a long time. So let's keep moving along here. We're gonna talk about this stuff really in depth, and start really zooming in. But I got to finish giving you this overall perspective on these 4 areas here. So the turnaround situation. When you think of Apple Computer, most people do not think of a turnaround situation, because Apple's been doing so good for so long, and it's such an incredibly dominant part of our life and in the economy, and the products, of course, are so amazing that you don't think of it that way. But Apple Computer was almost out of business several times. Steve Jobs, of course, was booted out of the company. And again, this points out a few things. First of all, a turnaround situation, you can get a company that at one time is doing great and then falls on hard times, and then refocuses and comes back and turns into sometimes even a much better investment than it was originally. Here's what I want to look at here, though. Is you can see that the iPod was released, iTunes Store, the iPhone. All this was on the table. Jobs came back. This was, if you go back to search the archives in the 1990s, when Steve Jobs came back, there was a Barron's article, and they asked me about Apple, and I said I was bullish on Apple because Steve Jobs was back on the job. And that was sort of my little catch line, or little phrase that I put. And that was in this period right here where they didn't even have the iPhone yet. This was based on iPod and an iTunes release later on in 2000. So the iPhone came out, and all this was on the table well before the stock even made its first big move up. And of course, Apple has still been doing well. But a lot of people call Apple the great turnaround now, and we're going to look at that later on. We're going to look at what happened with Apple, and as far as it was a story of eroding margins, and then an amazing story of expanding margins. So we'll talk about that in just a little bit. I want to talk about cyclical stocks here for a minute, because cyclical stocks have to be treated a little bit differently than your normal type growth stock. The thing with cyclical stocks is that they don't have these secular moves. They can't sustain the earnings growth over decades, and sometimes not even over many years, because of course they're cyclical. They move up and down with the economy. So what will happen with those is a lot of times, most of the time, the right time to buy a cyclical is when the PE is actually super high and all the news is bad. They're cutting the dividend. It just, everything looks terrible. But the stock is setting up. It's setting up from, coming out of a base. And then when the earnings are real strong, you'll see these giant earnings because they're going against these horrible comps from the, recession. Dividends are being raised. The PE actually comes down because now the earnings come in. It knocks the PE down and all the news is good. That's when you want to sell them. So cyclicals have what we call an inverse PE cycle, or an inverse maturation cycle with the fundamentals. So you have to look at these a little bit different. So this is why I'm pointing out, and showing you these various areas that we look at, because each of them have certain characteristics and certain things that you're going to look for that are going to affect on how you play those areas. Let me show you one other last thing here as far as the cyclical area, or what I call a commodity play. This is sort of a unique situation that you're not going to see too often, but I'm just going to give you an idea of how this works. So going back in 2004, 2005, copper prices took off and they doubled, and they made this big move. And I saw some copper stocks that were setting up, and I took a look at a little bit deeper into the company and found that this company, Encore Wire, they made copper wire. They had a huge stockpile of copper that they had already purchased and that they could make wire with. But now during that time that they already purchased this big stockpile of copper wire, copper prices just blasted off. So copper prices went up 100%. And then after that, they went up much more. They were up hundreds of percent. What this did was it gave them a automatic big boost in their profit margins, because they can now pass that price increase on to their customers, because they locked in the price of copper. They already bought it and stockpiled it. So I would never buy a stock based on just that. But this stock was coming out of a perfect base. It set up, everything looked just right. It met all the criteria, and this was sort of the reason behind it, at least that I could find. And the stock made a really nice move, and I got a double out of it in a pretty short period of time. So this is another way where you can look at sort of a commodity area in the market and see, if there's a way to play that. But again, like I said, they have inverse cycles, so you have to be a little more careful with the way you play
the other thing I would add to cyclicals and commodity plays is that sometimes they move when growth stocks are starting to falter. Maybe growth stocks have had a big move, and then there's still good money in the market, and the cyclicals start coming on. So there are times when growth is not going to work, but the market's going to move over to these. It happened, I remember, after a great move off the 1982 low, in 82 into 83, then it switched to more value type of stocks and cyclical stocks in 1984, until the market came back and had a great move in 85. So it happens from time to time. So you just be aware of that. But I think you'll still make your most money when you're in growth types of stocks.
Yeah. Now I want to show you something here that we're going to go back a little bit in time. And basically, I'm going to show you what I created, my first sort of model, if you will. But there's a bigger point behind all this. When I first started doing this, I really started looking into verifying, if you will, or qualifying the O'Neill work. And prior to the O'Neill work was the Love's work, super performance stocks. And that sort of, O'Neill carried Love's work forward, and I carried O'Neill's work forward. But I wanted to, take a look with my own eyes and with my own computers and see, if all these observations before me were still working in a current modern time frame. So I started looking at the biggest winning stocks and doing this factor model, going back and basically back testing a factor model. And what I found is that the big moving stocks, prior to them, before they made their big move, almost every single one of them was above the 200-day moving average, and the 200-day moving average was in an uptrend. Almost all of them, 96% of them, were above the 50-day moving average for the majority of the move. Almost 100% of them, 95%, had a pretty small float. If you went back to the 1960s and 70s, when Love was doing the work on studying the big winners, it was about 10 million. You fast forward into the 80s and the 90s, it was about 20 million. And then you moved another decade or so forward, and it was 25, 30 million. So it didn't really increase that much. They were still relatively small companies as far as the float or the shares outstanding. Almost all of them showed some type of earnings acceleration, and certainly this is something that you've heard probably many times if you've studied O'Neill's work, that you saw some type of earnings acceleration in the prior quarters. And this is really interesting too, is that almost all of them started their big move off of a correction. So I started viewing corrections as really just this great opportunity, because 96% of big winning stocks start their move off of a correction. And finally, upwards of 95% had some type of catalyst. And this is, again, would go back to, O'Neill type CanSlim, which would be the N in the CanSlim would be some maybe new product, new service, positive change in the industry. So this was sort of my first model, if you will. I wanted my stocks to meet this criteria. And I just decided, I said to myself, this is basically everything is 95% or better. I called it the 95% club because I wanted to have the highest probability of being in a big winner. So I said, I don't want to be in the 5% club. If 99% of stocks are above their 200-day, well, that means if I go into stocks that are not above their 200-day, I'm in the 1% probability, right? So this is how this all began for me. And I started building around all these probabilities and built what you're going to now see over the coming days of putting all the probabilities into your favor and really, putting the best odds of finding stocks that not only make big moves that are these big moves, but also velocity moves where they may be shorter in time frame, but very quick moves that you can compound very rapidly. The other thing that was interesting is that 70% of the biggest winning stocks already had earnings on the table of 20% or better in the most recent quarter or a couple quarters prior. So you didn't have to guess. You didn't have to go and buy stocks that had crappy fundamentals, because most of the time they were already on the table. And the absolute most interesting thing, going all the way back to what David was saying earlier about, these names are very often names that you haven't heard of yet. Like right now, everybody knows Amazon. But when I was buying Amazon in 1997, nobody even really heard of them. And the people that did hear of them hated them. Amazon was thought of as a company that was never going to make money. As a matter of fact, during that period, the prevailing word on Wall Street was that nobody would ever make money on the internet. And at the time, there was only one industry that was making money on the internet, and that was pornography. They had porn sites that people would pay for. And here's the funny thing: they said no one ever make money except pornography, and now everybody's making money, and pornography is free on the internet. So they completely wrong. They got it completely wrong. But the stock did not get it wrong. The stock was coming out of a base, hitting new high ground, and went on to make an 80,000% move over the subsequent years. 80% of the biggest winning stocks were IPOs within the previous 8 to 10 years. Now, that's a pretty young company. You can go back and look at Macy's was, founded in 1800 and something. You go back, Coca-Cola has been around since the early 1900s. A company that's only been around for a couple of years or even 8 or 10 years is a relatively new company. Now, that doesn't mean it's necessarily a new company. We can have, by the time Krispy Kreme went public, it was around for, I don't know how many years prior, but 50, 60, 80 years, whatever it was. I don't know exactly, but you have companies that have been around for a long time, but the IPO, I'm talking about the life of it being public, is within 8 to 10 years. So you want to look for those newer names. And finally, the groups, and this was really, really interesting. And one of the reasons why I sort of shy away from a lot of these areas, like the cyclical areas, only under certain conditions, gold, steels, paper, stocks like that. They weren't part of the biggest movers as far as the majority of stocks came from consumer retail, technology, computer related, biotech, drugs, medical, leisure, entertainment. 70% to 75% of all the biggest winners were in those 4 or 5 areas. So again, when you go outside these areas, you start going into, what I call, the 5% club, or even if it's the 20% club, you'd rather be in the 80% club, right? So again, we're going to talk about all this. We're going to keep moving forward. I don't know, Dave, if you have anything to share about this data, because you were instrumental in actually coming up with, the CanSlim strategy and popularizing it and going around the country doing seminars. Incidentally, I want to point out, some of you already know this, but I went to a seminar like this and saw David Ryan, I don't know, 30 years ago. I was sitting in a room and I was listening just like you're listening to us now. So first of all, it's a great honor and pleasure for me to be presenting with David. We've been doing this for a number of years now, but it's really just a beautiful thing that, how we've, moved forward from being taught. David was taught by O'Neill. I was taught by both of them. And now we're teaching people, and it's just carrying forward. And I love this, this lineage that we've created and keep moving it forward. So that's another reason I like to do this. But Dave, a lot of these things, you're in touch with this, these studies more than anybody.
Yeah, and I would just add that, as it says, there is nothing new under the sun. And these same characteristics that we're going to be talking about have existed, as you mentioned. There's examples from the railroads in the 1890s. They have the exact same characteristics as the stocks today that are having the great moves. And it's not going to change. These characteristics are not going to change unless there is such burdensome tax implications of raising taxes that new companies aren't formed anymore. But as long as we have a system that rewards entrepreneurship and innovation, these companies will continue to have these fundamental characteristics, and then in turn be rewarded in these technical characteristics of stocks that are in great, strong uptrends.
Yeah, the same exact thing. I went back and I looked at Coca-Cola and companies that in the 1920s and 30s, and you know what they look like? Coca-Cola looked like Monster Beverage. The technicals were going through the exact same thing as you see today with in a modern day time frame, nothing different. And the earnings were just these huge, enormous, 500% in a quarter, just like you'd see in some of these, these new growth companies. It was a cutting edge growth company at the time. So nothing has changed. That's probably, I mean, Dave, how many times do we hear, it's different this time? I mean, Jesse Livermore talked about hearing this in the 1920s and 30s, so we've been hearing this over and over, and, it's different this time. It doesn't work anymore. No, this is what we're going to be talking about for these subsequent days. It are all timeless principles. Nothing is going to change. Nothing has changed. All the technicals, all the fundamentals, everything what we're going to show you is timeless. It'll still be working many decades and centuries after we're gone, and it's been working, decades and a century before us. All right, so we're getting near the end of just wrapping up this area where we're talking about perspective, and we're just giving you shedding some light on these four categories, and we're going to do some more. We're going to do some more perspective, and then we're going to get more specific. But here, something that's really important. Again, this goes back to not only are we looking for newer companies, but in most cases, we're looking for brand new categories, brand new industries. And this is why it's sometimes hard to pull the trigger in some of these areas and buy some of these companies in the most opportune time, because you've never seen this before. It's a whole new area. It's this cutting edge area that you might not understand. Again, when I was buying Yahoo and some of these, and even, Amazon, these internet names, if you will, at the time, the internet, if you go back, there's a video, I think it's on YouTube still, of me being interviewed by Ron Insana in 98 or 99. Now, the internet has been around for a little while since then. And he was asking me if I thought the internet would survive. Like in 1999, 2000, people were still wondering if the internet itself was going to make it. So, these companies that were in that area, it was a scary thing because it was an entire new category, new industry. When you look at you go back mainframe computing. This is a crude timeline. It may not be perfect. So some of you, if you know, you're real sticklers as far as dates and history, this may not be a perfect timeline, but it's just an example. I want to show you how industries spawn off new industries. And this is happening right to this day. And I just want to show you how everything sort of is connected and how you want to look for that next area and not look backwards, look forward. Go back to the whatever 70s, 80s, mainframe computing. What you have now on an Apple Watch took up a whole entire room. It was floors full of computers to do what a little laptop can do today. That led to where we had computer networking, where you networked local area networks, you strung the computers together. Eventually, we needed software. For those of you who are old enough and remember when we first came out with MS-DOS, and we had this is why Windows was so amazing, is that before Windows, you would just have a little green light flashing, and there was really nothing much to do with the computer because there was no software and no operating system. And then when Windows came out and created the operating system, and then software started coming out, that's when we got empowered with the computer. Then routers, data storage started having to manage the data. We got all this data. Personal computers exploded in the 1990s. That led to a proliferation of computer peripherals, more software. Then we started tying the computers together online, right? The internet, you started to, those of you, of course, again, who are our age, Dave, you remember you hit the AOL and it goes, it would dial the phone number, then beep, make all that noise and take like 45 minutes to connect. It was very, very very archaic. So what happened then, we needed to start expanding the bandwidth, right? So then you had Broadcom, and you see underneath each of these categories that I'm talking about, there's companies that were emerging, and these were new companies and new concepts and had new products and services. Then internet, which actually Yahoo, Google is the internet search engine of that really dominates that. But Yahoo at the time was really the main search engine, and then later on they started diversifying, or what I call diversifying. They diversified, and Google moved in, top competitor, right? Google moved in and took over search and pushed Yahoo out of there. Then once we started having everybody online, now we needed security. Right, we needed security. We needed to protect the computers because people could break into each other's data. Now we put it on the cloud. Right, we put it on the cloud. There's social media, which of course this is all part of it right now. We got Zoom now. We could never do things like this. This is amazing. People from all around the world can watch and connect in real time. Social media just opened a whole new area of marketing and connecting and information flow. And now we're going into artificial intelligence and things like that, right? So to wrap this up, you're looking for totally new categories. And I like to tell this little story about going back to the cola, Coca-Cola. And when colas, basically, colas were brown. You look at Coca-Cola, it's brown, right? Pepsi's brown. Well, at one time, 7-Up did not exist. Clear colas did not exist. So 7-Up, what they did was they did a genius thing, and this is almost like a metaphor for the point I'm trying to make. But 7-Up took the color, or didn't put the color in; they left it clear, and they called it the Uncola. It was the birth of a whole new beverage, basically the clear, and they made it lemon lime and things like that. But that is really that's a totally new category. But still you're still in the soda industry. And this is what happens over and over again. Disruptive, breakthrough technologies, Amazon with their technology, just disrupted everything, just across the board in the retail area. So you'll get what some call it the cousin effect or the spinoff. You'll get spinoffs, the spinoff effect. These are solutions that come out where you get just a better mousetrap, a better way of doing business. Netflix was a perfect example of a better way of doing business that Blockbuster was doing. It just was a better mousetrap. And again, things getting smaller: mainframe, desktop, laptop, tablet, smartphone. I don't know what's next. Maybe a little chip they put in your head. That's the next thing here. So this is really, giving you that big, broad perspective. We're going to come back. We're going to take a break, and then we're going to come back. This is just, there's some stuff on here too. There's some pages that are just for your own edification that we're not going to go over, but we went over every page in the workbook so far up to this point. This last page here is just going to contrast you of the what you're looking for and the things that you want to stay away from. Best candidates: growth, accelerating EPS, accelerating revenues, explosive market position, sustainable trends, business models that can be scaled. The worst areas are capital intensive. It takes a lot of money. They don't have much pricing power. There's a lot of competition. They can't really define themselves in the marketplace. Heavily regulated, very hard to operate in a regulated market. Lots of margin pressure. When you have lots of competition, the margins get squeezed. Only the consumer wins when you have lots of competition. And if you're eroding industry position where they're losing their position in the industry, those are the areas you want to stay away from. And the areas that you are the best areas are the growth candidates. So.
And Mark, I would also add, from the slide before plus this one, it's a lot of these companies are companies and areas that you as an individual have, probably have a lot of experience with, or you might be working in the industry, or you might be buying these new products, or or using these new services. And so you can find a lot of your great candidates from your own life of what you're buying, where you're eating, what services are coming into your home to take care of things. So it doesn't have to be so. You don't have to be some technological wizard to figure all these things out. A lot of these things are right in front of you and part of your own lives. And that's where you come up with some of the greatest growth stocks are the ones that you're using yourself.
With the whole Netflix and Blockbuster situation, I saw it unfolding right in my backyard. All of a sudden, there was just the mom and pop video stores were going out of business. Netflix, had already come public, and they were doing business, but I didn't use Netflix yet. I was still going to stores and buying them. But there was this place I remember called Tommy K's, and they went out of business, and there was a bunch of them that were just starting to go out of business. And I saw that shift, and then I saw the stock charts, and that's where it really hit me, where this is a new way. And I didn't really believe in it, even when after Blockbuster was wiped out, I didn't believe in Netflix. Matter of fact, even to this day, I don't really think Netflix is the greatest product. But again, it's not my place, to make that determination. It's again, the stock is setting up. It's got the right criteria. It's showing the leadership. I buy the stock. I let the stock make that decision for me. So we're going to show you how to do all this now. I'm going real fast here. This is a lot of information. And I know in the past, we've had people say that this seminar, this workshop is like drinking from a fire hose at times. At times, I'm going to go really, really quick, and I'm going to sort of force all this information. There's other times we're going to go really slow, and we're going to really look at things and examine them very carefully. Again, right now, we're just sort of setting the stage, and we're going to do that again for the next two sections are going to still be basically just perspective. And then we'll start getting more specific. So right now, we're going to take a break, and then when we come back, we're going to get into the next topic, and we'll see you in a little bit. Okay.